We're at Caledonia Mining. I draw your attention to our disclaimer, which you can read at your leisure. Just a summary of the business. We own the Blanket Gold Mine in Zimbabwe. It is a mine that we bought off Kinross in 2006. In terms of scale of the asset, last year it was a 56,000 ounce producer. All-in costs were just shy of $850 an ounce. So, fairly healthy costs. On a cash basis, those costs were even lower, but obviously there's constantly sustaining capital investment for a mine. This year we're shooting for 59,000 ounces. Our official guidance is 55 to 59, but 59,000 ounces is where we're targeting, and we're currently investing fairly heavily in the asset to grow to 80,000 ounces by 2021. And with that, the additional economies of scale that we'll get, we expect to get our operating cost down to somewhere between $700 and $800 an ounce. We've got about 1.6 million ounces of gold in the ground. I'll talk you through that in more detail later. It supports a mine life out to about 2031. We pay a dividend. Dividend yield is just under 3% at the moment, so slightly unusual for a gold mining junior. And we're well cashed up. We have a good balance sheet, 13.4 million in the bank, very small amount of debt just for liquidity management, so the net cash is about $12 million. So a very healthy balance sheet, dividend yield, and some good growth profile in the business. This is our annual results. So this is last year's 2017 results. The number I draw your attention to is operating cash flow from the asset. So $24.5 million of after-tax operating cash that came out of this business in 2017. We just released our quarterlies. I've got a slide on that now for quarter one. Most of that money went back into the ground. So you can see the capital investment was fairly substantial, $21.5 million. So we made 24.5, we invested 21.5, and the dividend, that 3% yield, cost us about $3 million. So the market cap is currently $95 million. So a very strongly cash-generating business, healthy operating margins, good growth profile. We are obviously in the middle of a capital investment phase. When we bought this mine of Kinross in 2006, it had about 10 years of life left in it. It's now 12 years since we bought it, and we obviously have to keep investing to go deeper. That capital project comes to an end, as you would gather, in 2021 when the 80,000 ounces target is delivered. And at that point, we'll be in the happy confluence of operating cash flow rising on the back of rising production and lower operating costs. And that CapEx falls off a cliff. So the CapEx that is currently that $21.5 million becomes about $5 million long-term sustaining CapEx. And we have this wave of free cash flow that comes through, which I will explain to you as we go, is the investment case for this business. So we just had our quarterly financials out. Again, you can read these numbers at your leisure. There are presentations outside. But again, the number I draw your attention to for quarter one last year, so this year, so just January, February, March, operating cash flow is $7 million, helped by slightly higher gold price and some improvements in the Zimbabwean royalty environment as they're gradually moving in a post-Mugabe regime to try and make the environment more friendly. But again, this business is generating a lot of cash. We invested quite a bit of that. Which obviously, as I say, will be done by 2021. It's just our operating metrics. We're mining at about a grade of about 3.5 grams, which is low grade for an underground mine, but we have certain factors which keep our operating costs very low. Namely, we're mining very, very wide stopes. So you go underground in our mine, you'll see underground mining areas as wide as this room. So almost a bulk underground mining operation. Our recoveries are very, very good. We're getting, the gold 93%, 93.5%, over 93% recovery. Half the gold drops out in the gravity table, and we have no refrigeration costs or deep-level pumping costs like you have in many of the deep-level South African mines just south of the border. So operating, the business is in great shape, and the operating numbers speak for themselves. As I said, we're in Zimbabwe. It has been a tough jurisdiction, a tough neighborhood since we bought the mine in 2006. I don't know how closely any of you follow the politics in the country, but things have improved quite dramatically since last November. Not many people know this, but Zimbabwe, prior to, back in the 1970s and 80s, was the third biggest gold mining region in Africa. So it was bigger than Ghana. Sorry, it was behind South Africa and Ghana. It was bigger than Burkina Faso, Mali, Ivory Coast, Tanzania, all of these places. Now you go back, so you've effectively got a time capsule from when gold was $250 an ounce in the late 90s, or before that when the world was still on a gold standard effectively, and all of the bull run in the gold market Zimbabwe has not participated in, unfortunately because of the difficult policies or the difficult economic environment that the country experienced. So we really do believe it's not overselling it to say that this is one of the last gold frontiers in Africa. All of that gold is still in the ground. We're the only listed cash generative and profitable player in the country plugged into the capital markets globally to go after this. We believe we have a competitive operating advantage in the country, and we think we're well placed to take advantage of these opportunities. So we're down to the south of the country here in a little region called the Gwanda Greenstone Belt. So it's pretty close to the South African border. We're about an hour's flight from Johannesburg to Bulawayo and about a 2-hour drive to the mine. We can get critical spares in the back of a truck from Johannesburg and get them up to the mine overnight, and we've done that in the past. We have everything we need to operate a gold mine here. We have paved roads all the way up to the gate mine gate from Bulawayo. We have grid power, we have water, we have logistics and supply chain that we manage from Johannesburg. So it's a fine place to operate a gold mine. And as you can see, there's lots of gold in those hills, to put maybe an old cliche. This region here, this is the greenstone trends you see in the country that run. The country is about half the size of Germany, for those of you who don't know the geography of it. And this region here is about the size of Burkina Faso. So this is a big gold-producing belt. This is some of the major production historically. So the region has produced about 45 million ounces of gold in the past. That's tailed off a lot, unfortunately, in the last sort of decade or so. But there's quite a long track record of gold production. As I said, we're down in the Gwanda Greenstone Belt here. And you'll see roughly consistent grades, relatively large production, and fairly significant resources are available. For those of you who are uncertain about the politics, we can talk all we want. I would draw your attention to an article written by the president in the New York Times about 2 months ago. This is you'd have to take him at his word, obviously, as to what his intentions are for the country and how they intend to encourage investment. But we certainly have seen this firsthand in our own dealings in the country. Just recently, Zimbabwe reduced effectively cut the royalty rate on gold miners to -5%. So effectively, we get a 5% premium above the gold price for mining gold in the country. So how that works in terms of mechanics, the tax rate is 25%, and then there's a 5% royalty on production, royalty on turnover. Pretty standard for most operating most regions in the world. And then there's an export credit incentive to anyone who exports anything, effectively, so tobacco farmers, gold miners, etc. That export credit incentive is 10%, so effectively that comes back on the royalty. We think this puts Zimbabwe in some of the best fiscal terms, certainly in Africa and possibly even in the world, for mining operations. So if you're interested in forming your own opinion on the politics, just Google Emerson Mnangagwa New York Times and see what the man wrote in the New York Times, and you can form your own opinion. I mentioned, so Zimbabwe's indigenization legislation was one of the key impediments to investment previously. This is a live issue we're dealing with at the moment. The reason I put the slide up, we're currently in discussions on this issue, but and the legislation here was scrapped in February this year. So effectively, prior to February this year, gold mines had to be owned 51% by local Zimbabweans. We are currently still compliant with that legislation. We were the only mine to comply with that legislation, and we put a structure in place in 2012 to do that. Effectively, the transaction was 51% of the mine was sold to 4 indigenous partners. So our employees own 10%. The local Gwanda community owned 10%. The Zimbabwean government owned 16%, and a group of Zimbabwean businessmen owned 15%. The financial transaction that was facilitated to put this deal in place, the local Zimbabweans didn't have the money to pay for the 51%, so they were extended a $30 million facilitation loan. This is similar to the South African BEE structures that are in place. That loan is repaid through us getting preferential rights to dividends from this mine until such time as that loan is repaid. So a relatively simple mechanism to repay the loan via dividends. So when the mine pays $1 or distributes $1 of profit to its shareholders, we get 49 cents that we're entitled to, and then the 80% of the loan that would be entitled to, that these indigenous partners would be entitled to, is then repaid back to us. So effectively, until that loan is repaid, we control about 80% of the cash flows. The reason I put this up now is, one, it's a live issue that we're dealing with, and we're in negotiations currently with the government and with some of our local partners to buy back on a willing buyer, willing seller basis. We obviously haven't agreed a transaction, we haven't agreed a price, but we have made public statements that say that we are currently in discussions here. But this is, in our view, another step we see the government taking to make the country more investor-friendly. This legislation has been scrapped completely. It no longer applies to the gold mining industry. And if these discussions are successful, we'll see ourselves as an 80% owner in the mine hopefully this year. That will obviously, we would keep in the local ownership of the workers and the community, not for any legal reason, but because we believe it's good business practice and it gives us tremendously good community relations and worker relations. So a shareholding that we would not want to unwind. This is our capital structure. You can read this at your leisure. Again, cash 13.4 million, net cash is about 12 million, so a very healthy balance sheet. Major shareholders are a company called Allan Gray. They're a South African institution. They own about 21%. Just over 20%. They bought all of that on market over the last few years, and it's been a very good investment for them. We benchmark ourselves against the GDXJ, and it's been quite a good outperformance here, and most of this outperformance, interestingly, has been the dividend. So this dividend used to yield about 10% when the share price was much lower. If you factor in the cumulative effects of dividends, we believe there's more than the mining industry there's lots of people promising substantial capital growth. We believe there is a place in the sun for the steady producers who consistently deliver results. These are resources. As I said earlier, we've got about 1.6 million ounces, the number on the right-hand side. About 900 of that is inferred resource, so the slightly lower confidence, and the rest is measured and indicated. The important trend here is the growth, though. We've replaced resources every year since 2011, and that we've probably mined about 250,000 ounces from this mine over that time. So a good trend of resource replacement. The mine is 112 years old, so it's one of these vertical greenstone ore bodies that just keeps going deeper and deeper and deeper into the earth. It's never ever had a 112-year mine life. So there is always an element of replacement and extension of the life of the mine over time, and that we certainly don't expect to be closing down but in 2031. There's lots more gold at depth, which I'll show you in a moment. So that's the cross-section of the mine. This is so this is a long section sliced through the ground. That's surface, and that's a depth of about 750 meters. And that's 3 kilometers probably left to right. So these are the ore bodies we exploit. The gray stuff is stuff that's been mined out over the life of the asset. That's our reserves, the dark yellow and blue. These are our resources there. So you're looking, the lighter yellow is indicated resource. The more shaded area depth here is inferred resource. Those are drill holes that we've intersected, I think, above 2 grams, or 1.8 grams over 1.2 meters. So these are some of the drill holes. The point we're trying to illustrate is a lot of it is actually outside the current resource. This gold tends to go deeper and deeper. It's prohibitively expensive to drill this thing from surface. You've got to currently get down there, so we're always going to be constrained as the mine keeps going deeper and deeper. But we certainly don't feel resource constrained as a business. There are far more exploration targets. The geologists tell us, I'm not a geo myself, but the geologists tell us that this is where the gold ore came from, so it was squeezed up into the earth, and so as we keep these ore bodies tend to go very, very deep into the earth. So there's a few more exploration targets there. Just in the interest of time, I'll go through this fairly quickly. We're investing $4 million on satellite projects which could feed the mine. So this is a planned view of the mine. Those are our neighbors. Incidentally, they're at a depth of 1.5 kilometers. So they're double the depth we're operating at the moment, and they're 3 kilometers away. So if we're as lucky as they are, this gold keeps going for a long time. But there's a few sites out here that we're exploring that could provide us with satellite feed, and we're investing $4 million in that. So the nub of this investment case is a new shaft that we're sinking from surface down to a depth of 1,330 meters. This is chasing after the resources at depth, those 1.6 million ounces of gold resources that you saw in the earlier slide. The infrastructure we bought from Kinross has served us very well, but you've got to keep extending, you've got to keep fixing the roof while the sun's shining, and this is what we're doing. So this is a brand new shaft, a substantial investment. We'll be investing $50 million out to 2022, and that's all funded from internal cash flow. You saw the operating cash flows we made earlier. So you'll recognize this picture. It's the same picture we showed earlier with the resources. Now I'm going to overlay on this our operating infrastructure. So that is the 750 meter level. You notice the grey stuff that's mined out is above 750 meters. That was where the existing infrastructure was constrained to. That's foreshaft, and the green levels are the current operating infrastructure we have, and most of our production comes on this 750 meter level down here, which is 22 level. That's where our men come down. So if you're a miner, you come down here. You then there's another shaft called Six Winds, which gets us slightly deeper into some of the higher grade areas at depth, which is our only shaft access to deeper areas of the mine. But if you're a miner, you come down here, you either come down Six Winds or you walk with a drill rig on your back 2-3 kilometers, and then the rock gets mined in these areas here, and then trammed all the way back on rail cars and back up here. So this is not how you would build a mine if you were building it from scratch. It's only, the shaft's really in the wrong place, and the men shaft is really, far away. That's the central shaft. That's what we're building at the moment. It is a one-drop shaft all the way. It's a 6-meter diameter shaft. So it's the Jethro shaft here. We fit about 15 guys in a cage fairly uncomfortably, and it takes them a long time to trundle down to the bottom of the mine, and they have to walk very far. This central shaft fits about 80 guys in a cage in 2 double-deckers. It goes much, much faster. It moves men, materials, rock, all at one shot. It moves about 4 times the speed, and it's going to set up 4 operating levels at the bottom of the mine. This is going to set us up infrastructurally for about 20 years. Obviously, that's resource dependent, but once we've got infrastructure down here, we can drill these things out at depth. So we can start drilling and following up, proving up this inferred resource, none of which is in the mine plan, following these resources deeper and extending down. Like I said, our neighbors are at about a kilometer and a half, which is down there. So we'll be, this mine's going to set us up for many years to come. That's the first red level that you saw down there. So these are some photographs we took of the mine. Those guys are 6 foot tall. This is a big operation. We're currently at a depth of a kilometer, and that first red level is already in production. And this is what it means for production, right? So it's had a pretty good growth profile since we started the project. We're targeting 59 this year. We'll get to 80 by 2021, and that'll get our costs down to about $750 an ounce. These are some numbers published by Edison. You can check them on the Edison website. But this is where the maths gets easy from an analysis perspective. We'll have an 80,000 ounce operation at an operating margin at today's gold price of $550 an ounce. That's $45 million of EBITDA. After taxes and minority interests, I mentioned we'll probably have an ownership structure of about 80%. And the current tax structure, we're talking free cash flow, cash flow before capex of about $25 to $30 million, and long-term sustaining capital for this business about $5 million. So we'll have free cash flow at today's gold price at about $25 million a year. And this is probably the most important slide, I think, if you remember nothing else. This is exactly out of our cash flow statement. So these are actual numbers for 15, 16, and 17. You can see the light gray bars are operating cash flow. The dark green bars are capital investment. So last year, as I said, we generated $25 million, 24.5. We invested 21.5, and the dividend cost us 3. Right? This year is another heavy capex year to go, and next year is also a heavy capex year. We've got $21 million to invest each of those years, both of which are covered by cash flow, and both of which will support both the capex and the dividend. So we'll be covered in both of those years. But then after that, we commission the shaft in 2020. It's at full production in 2021. Operating cash flow rises, and investing cash flow, capex, tails off quite nicely to about $5 million long term. And that really is the investment case here, this wave of free cash flow that we, now if you consider the dividend costs us $3 million at the moment. So last year dividend paid was $3 million. When we're having free cash flow of anywhere between $25 and $30 million, depending on the gold price, we can grow that dividend very, very substantially. Or we can look at investment opportunities in Zimbabwe. And we believe there's plenty of those. I mentioned dividend. This moves around a bit, but we still are a pretty good yield given the level of cover we've got. This dividend is 8 times covered by operating cash flow, and it's still a reasonably healthy yield considering some of the we're not in the league of Randgold and those sort of people, but their yields 1% in that sort of level. So, in summary, just not much time left. We've got a very good production growth profile, 45% growth plan from last year's production base. Still a good dividend yield. It's not as good as it used to be, but that's because the share price has risen, which is the way we want to see the yield drop, not to have to pull the dividend. A good margin operation, so we would back ourselves to survive virtually any conceivable gold price going forward once we get our operating costs down to about $750 an ounce. And a very strong management team. We have good relationships in country. We think we're getting to the stage after having run this mine for 12 years where we believe, in all modesty, our track record speaks for ourselves. And the people we've got running it know what they're doing and have a good track record in country. So that's really all I got. I don't know if there's time for any questions.
There is. Perfect timing. So questions, so 2 down here.
Hi. That was a really good presentation. The question that I have is to do with your dividend policy and government policy. Is it possible for you to externalize the dividend for overseas investors?
Yes, it is. We are listed on New York, AIM, and Toronto, and the dividends are paid on those exchanges. So, yeah, there's no. The dividend is paid, and it has been paid since 2013, into a brokerage. So my dividend appears in my Hargreaves Lansdown account every quarter. So, short answer is yes. Foreign exchange is an issue. So, if there are any concerns about foreign exchange, it does require a lot of management attention. So, Zimbabwe doesn't have their own currency. And Zimbabwe has a trade deficit. So if you don't have your own currency and you have a trade deficit, the dollars bleed out of the country slowly. That's a difficult situation for them to manage. So there are very strict exchange controls, but exporters who bring in foreign exchange are very, very critical to that economy. And as a gold producer, we're one of the larger, I think gold is 60% of all foreign exchange generated. So the gold producers certainly are critical to the Zimbabwean economy and to to provide foreign exchange. But yeah, my salary, all of our operations all get paid for by cash flows from that mine, and they have been so for. It's our only asset, and that's been the case for a decade.
Gentleman, just gentleman down the front. Sorry.
Gold grades to improve as you mine deeper?
Yes, we do. Our average resource grade, and you can see this on our website, the average resource grade is about 4.5 grams a ton. We're currently mining about 3.5 grams a ton. The measured and indicated grade, which is the higher confidence stuff, is about 4 grams, and the inferred grade is about 5 grams. That inferred grade is, the reason the inferred grade is higher, it's not just because it's at depth, it's because it's in one of the higher grade areas of the mine where we've had the infrastructure to explore. So I would expect over time, as we grow our resource base, and we've got an update coming out in September, that you would see average grade would probably come down a little from 4.5 gram down to somewhere still comfortably above 4. And the inferred resource will probably grow, but I would expect to see the grade potentially come down from 5. Having said all that, if you're mining at 3.5, we expect the grade to average about 3.8 to 4, which is the long-term operating history for about 100 years. So we are running out of ore above the current infrastructure at 750. Which, when you get into the virgin rock, you do get back to resource grade.
Question.
Hello. Your patience has paid up with the previous government, and you have built up now the good repo of your mining company. How many hours your miners go underground to work?
I couldn't tell you. We run a shift system. I think I would have to get back to you. I don't know exactly how they. I don't know exactly how many hours they are going underground.
There were some labor laws there.
Oh yes, absolutely, and we have very good relations. The workers own 10% of the mine.
You're going to benefit your workers. Now you are in a different government, and you are running this mine a bit successfully now.
Well, the workers own 10%, and they will continue to get 10% of the distributable dividends from the asset. And we see that we see this being a situation for the next, well, certainly till 2031. But as long as we keep finding resources, there is a workers' trust, of which the various elected members of the unions and management are represented. So no, it's a model that works well for us. And I would say our labour relations are very good, partly as a result of the share ownership. Yeah.
More questions, anybody? I've got one. You're going to try and buy back 31% of the shareholding that's standing. How will you finance that? Your cash flow isn't sufficient at the moment, your free cash flow isn't sufficient to do that. Will you go to the market, or will you borrow money? What's your plans?
No, we won't do either of those things. Let's remember that there is a loan outstanding against that 31%. So whilst there currently is a $30 million loan that is outstanding against 3 of the indigenous parties. Now, the structure is a little complex, but against 3 of the indigenous parties owe us $30 million. That breaks down roughly between the government and the private Zimbabwean citizens, who are the parties we would like to buy back. Those loans break down, and they're declared in our MD&A, but approximately $10 to $12 million each. And I think it's roughly 11 and almost just under 12 for the government and just above 10 for the private citizens. But I'd have to verify those numbers. I don't know exactly. So any transactional price that we would agree would potentially have the loan netted off against that, and then there'd be a net transaction cost. Again, I can't comment on the exact price because it's something that would be subject to 1, independent valuation, and 2, probably a fair and reasonable opinion by the regulatory authorities because of the nature of the transaction. But we anticipate either being able to do a combination of cancellation of the loan and some cash, or potentially issuing the parties with Caledonia equity. So that's the mechanism of the transaction. So to be clear, we probably would issue some equity. It wouldn't be via the public markets to raise capital. It would be potentially rolling some of the parties into...
Just an issue of new shares to them.
Could be. But again, it's a live issue which we expect to have some clarity on over the course of 2018.
Great. And then just one question there.
Given the tricky nature of Zimbabwe, where is your senior management based, and how does it all work with the different operations and the listings where you all live?
So our CFO is in Jersey. We're a Jersey company. I'm in London. The chief exec and chief operating officer in Johannesburg, and the mine staff are based on the mine. Obviously, the mine GM and people there. So, from logistically, the supply chain operation is run from Johannesburg. So the sourcing of raw materials and equipment for the mine, that is, and then it's an hour's flight. So it's not a particularly onerous. Same time zone, pretty good infrastructure and telecommunications. That's where the management sit. And then listings is not too onerous, but unfortunately Canada, you pay lawyers for most of the stuff, and then the US and here we manage that ourselves.
Maurice, thank you very much indeed. Thank you.